Hello there, welcome to Peep Profit. This is Banzile. If you are watching this video for the first time, please kindly subscribe to the channel, like the video, and comment down below. Let me deal with this in this video. I want to talk about how to analyze volatility index 75 without indicators. Now, I've done a lot of research in this instrument. I've traded it for a very long time, and every now and again I would go to YouTube to check if to check what people are saying regarding how to analyze volatility index and how to use certain strategies to guide your entries. I have to say that most of the content that I've watched, the people that claim to be VIX experts, they will recommend that for you to enter and for you to make an entry position, you have to, for instance, you have to wait for the 100 SMA to cross price above in order for you to make a short, or you have to wait for the 100 SMA to make to cross the price below in order for you to go long. But that is such a very dangerous uh, approach and strategy to trade volatility index 75, because this kind of instrument can turn a wedding into a funeral in just seconds. And what I've noticed is that most of these guys, they do their videos without showing us their running positions. So they are sort of using the chart and then going back in time to look at where really the price crossed below the moving average or crossed above the moving average. If I can make an example, let's add the 100 SMA. We have the 100 SMA, and it makes sense when somebody tells you that whenever the price crosses below the moving average here, it makes sense that you're going to short the market. But the problem is, none of these people can tell you when is the perfect entry, because you can't just enter when the price crosses below the 100 SMA. It will, there will be a huge drawdown, and you might find that your entry goes into a negative running for a very long time, and it will take a while for you to break even with the market, just because you use the 100 SMA as your guide to enter the market. VIX 75 requires that you only use market structure, so you remove indicators. This is very important. You have to remove indicators and just work on a naked chart. Indicators allow you to use they allow you to identify very, very important things that you cannot trade VIX 75 without these things. Number one, VIX 75 uses support and resistance a lot. Number two, it uses formations in its movement. And these formations, they are very important, because these are the formations that tell you, this is basically how the market maker tells you what to expect in the near future, in terms of how the market is going to perform. There's an obvious market formation that is in front of your screen right now, and it happened around an area of resistance. And let me just use the brush tool so that we can identify this formation together. So here it is. And that was the neckline. So what we had there is that we had inverse head and shoulder. Let me use the smaller marker pen. Oops, what's happening now? Okay. And we had this neckline here. The market maker here basically was telling us that the market is about to go down because of this head and shoulder here. It's a rejection of higher prices. But even then, your entries should not be guided by a certain indicator. Your entries should be guided by the knowledge of how to trade a head and shoulder. So you know very well that when you're trading a head and shoulder, your entry positions should be either in the head or in the second shoulder. So that's where you take your entry positions. How do you calculate that this is where the head is going to be? That is a very important question, because it's one thing to identify that the market is going to make a head at some point, but how do you identify that this is actually the head? This is what I'm about to recommend. Do not by any chance make an entry position here in the head. The best alternative is to wait for the market to form the head. So the market will form basically the setup, né? And then use the clue that this is support. This is a resistance. This was the area of resistance there. Use that clue as your guide that this might be a head forming up here, and so expect prices to decline up to this level. Now this is where you can use the RSI to check whether the instrument has been overbought here. So if the price rallies all the way up to this area here, you know very well that a sell is coming. So now you have a clue that the market is making the head here. Now what I recommend is that your entry position, you take it in the second shoulder. Why? Because now you already have the first shoulder and you have the head, and it makes sense now that here when the price reaches down to this lows here, forming another point or another bounce within the neckline, the market will make a rally up to this point here, and then as per your calculations and your observations, you notice that this is the second shoulder forming up, and then you make your entry positions here. Again, I recommend that you use the RSI to mark the area that might guide you that this is actually the instrument at this point has been oversold, and looking at the head and shoulder, because even the RSI is going to show you the first shoulder. The RSI didn't go to the extreme of going up to the sell level here. Only the head came up to this point where we consider the instrument to be overbought. And even this side, expect the same. The RSI, the line inside the RSI didn't go up to that point there, it ended up here. So this is another clue that you can see that this is actually the second shoulder forming up. And then you place a sell limit. You place a sell limit here. So you place the sell limit at the highs of the first shoulder. Yeah, you place the sell limit at the highs of the first shoulder, and this is the highs of the first shoulder, and this is the second shoulder here. So as you can see, this is the high of the second shoulder. If you entered here a sell limit, the order would have been triggered. There's a little bit of a play that happens there where it might create a lot of panic, but consider your risk versus reward ratio. Now the market went down in your favor, and it really did. The market went down in your favor. The prices descended all the way down to this level here. Prices descended all the way down to this level here. So you could have enjoyed the move not only by selling when there is a breakout, below the neckline here. So you could have